with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at B.I.G. Investment Services. That's B.I.G., Booth Investment Group, for full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, April 25th, 2025. And I got to start off with a huge shout out to some of the most awesome people in this country, on this planet. And that would be our clients. What an awesome week. We celebrated 20 years of B.I.G. Had well over 100 some people come out and spend some time with us on Wednesday, had some good food, some good music, and nice hanging out with everybody in a little more casual setting was fantastic. And then those that couldn't make it, we got hundreds and hundreds of clients all over the country. They send emails and cards and gifts and things like that, well wishes. We just appreciate you all so very much. We continue to work tirelessly to make sure your outcomes are what you want them to be because we really super appreciate you. That's why we do what we do. Right? To see your dreams come to fruition. And we've seen it happen now, 20 some years. I've been doing this for 25. I've seen little babies now graduated college and getting married and daydreams of retirement become reality. Folks traveling the country, doing what they want to do. And we just love to see those outcomes come to fruition. So thank you so very much. So let's talk about the markets. Solid week for the markets this week. As we expected, look, we said last week, the market was poised to go higher. We thought we were in the midst of a pretty good rally here that would carry forward for a few weeks, and so far so good. Dow Jones up 2.5% this week. S&P 500 up 4.5%. The NASDAQ Composite up 6.7%, and the Russell Small Cap Index up 4%. So all the major indices pushing higher this week. The Volatility Index, as you might expect, down quite a bit, down 16% on the week, coming in at a 24.8. So down quite a bit there with the market moving higher. And then looking at long-term bonds, they actually had a good week too, up 1.5% on the TLT. So long-term bonds going up, interest rates coming down. Market really like to see that. That's a positive as well. When you take a look at the sectors, what we saw really doing well was the more growthy areas of the market. Things like semiconductors up 10%. We had technology as a whole up 8%. Consumer discretionary, things people want, not what they need, but what they want, up 6.5%. Communication services up 4.6%. All these things doing very well. And then the more defensive areas of the market, things like consumer staples, things people need, not what they want, but what they need, down 1.2%. Utilities only up 0.5%. So a little weakness there in the defensives and a lot of strength there in the more growth-oriented areas of the market. Looking at the metals, gold down 0.5% this week, silver up 1.6%. And let's talk a little bit about gold. I think gold has had a blow-off top. Okay, hitting record highs this past week. I think it's had a blow off top, and I think it's going to go lower. So we've got a gold mining company in our portfolio, Kinross Gold, doing great for the year, up 56% on the year. It's been fantastic. But I did do some selling today. I trimmed back on that further just to take some of that profit out because I think gold can push its way back down, maybe around $2,000 an ounce, give or take. But when you look at the Fibonacci retracement levels, what's that? Yeah, Fibonacci retracement level. So Fibonacci, these are patterns found in nature. And interestingly enough, the stock market many times tends to follow these same types of patterns. And it's just another tool that I look at sometimes when it comes to how low can something go and that sort of thing. I think gold can probably work its way down around that $2,900 level. So took some profit out of that and happy to do so. It's done real well for us year to date. Looking at everything else, listen, this market's got a lot going on right now. It's being pushed a lot by headlines. Earlier this week, President Trump said something about firing Fed Chief Jay Powell. And on Monday, the market just looked horrific. I was actually kind of surprised, like, wow, I thought the market was looking pretty constructive. And it was an ugly, ugly day on Monday. But then, as we said might happen, right, some more positive headlines are coming out regarding tariffs, a deal here, a deal there being worked on. Market responded very positively to those things. And then there's some things being said that I don't know how true they are, but the market wants them to be true. That's for sure. So there was some comments made that we're talking to China, and the market loved to hear that. But then China came out and said, no, we're not. We haven't heard from you. We haven't spoken at all regarding tariffs. So who knows? Are we talking to China? Are we not talking to China? I don't know. I'm not sure if anybody knows. But anyway, the market doesn't seem to care at the moment. What I will say, when you're taking a look at the economic data, the earnings, is at the end of the day, that's what's most important. Economic data is sloppy. Okay, we're seeing some things that are a little bit better than expected, other things that are not. So it's just a mixed bag and pretty sloppy. I think a lot of the potential pain that is going to come from everything that's happening here with tariffs is probably not showing up yet. Okay, I still think that's not worked its way into the numbers just yet. And then there's still, U.S. federal layoffs and all kinds of things happening there that aren't going to show in the numbers yet. So there's a lot going on there that I just don't think is being reflected. And then there's the earnings of companies. Now, earnings have been okay, and they should be. Look, the worst of the tariffs, again, haven't worked their way into the numbers yet. The year started off great, January, February. So things really didn't start to deteriorate a whole lot till March. So first quarter numbers for these companies have been okay. But here's the thing that concerns me. Earnings expectations are declining at a bigger rate than they have the last 2 quarters. We've talked about this phenomenon in the past. I work with Earnings Scout, Nick Rake over there, great guy, really onto something here in regards to the rate of change on earnings. Okay, the rate of change. So if earnings expectations are dropping, 10%, right, this quarter and 10% the next quarter, and then they drop again the third quarter, but only 5% instead of 10, the market seems to key off of that. It seems to move on the better rate of change. And same with the other way around. If earnings expectations are going higher, and they're going higher by 10%, but then they're only going higher by 6%, and they're only going higher by 3%, the market tends to react to that as well. Well, earnings expectations moving forward are declining at the biggest rate that we've seen in quite some time. That's concerning. That's concerning because that could spell some trouble for the market ahead, maybe into the next quarter when we start getting this next quarter's earnings a couple months from now. So we'll have to kind of watch all that stuff pretty closely. Now, on the good side of things, we have seen some signals from consumer sentiment and some other technical signals and indicators that you only see when the market has bottomed out. The bottom of 08-09, the bottom of the 2003 bear market, the bottom of COVID. I mean, you only see these things at the rock bottom of a market decline, and looking out 12, 18 months ahead, historically, the numbers are fantastic for the market. We also got a breadth indicator. In other words, market participation, right? All the stocks in the stock market, how many are moving higher together? We got a breadth indicator this week that has a 100% track record of reflecting positive, double-digit positive returns looking 12 to 18 months forward. So there's a lot to be said that it's not all doom and gloom out there, and the market could really put out some strong numbers here further down the road. But I still think there's some wood to chop between now and then. And look, a bottoming of a market is usually a process. It's usually not just down and straight up again. It's not how it normally works. I think very strongly that we're going to probably have another move down at some point, a retest of those lows that we had a few weeks ago in the S&P 500. Now, right now, the market's looking constructive. The market indicators reflect that this can continue for maybe a few more weeks. The S&P oscillator looks a little rich, so maybe it's not going to move up as much and as quickly as it has this past week, but I do think things continue to look constructive in the short term. There are some key levels that we're watching. I mentioned 5,500 to you on the S&P 500 maybe last week. Well, we got over that today. 55.25 is where it closed. Not only did it close across this threshold that I thought was the first key threshold it had to get over, but it also got over this downward sloping trend line that we've been in since February. That's a very good sign. The next level is the 50-day moving average. That's 56.46 on the S&P, so about 3% or so higher from here. But then we start to get into a territory that's going to be very difficult. It's a hurdle that's going to be hard for the S&P to cross. It's right in the mid 5,700s on the S&P, right around that 200-day moving average. that's going to be pretty challenging. And at this point in time, until proven otherwise, I think this is probably a bear market rally. And I would expect the market to fail somewhere between 5,600 and 57 and change on the S&P and probably work its way back down again. So what does that mean for us? It doesn't mean anything. We're sitting great right now. Look, we did a lot of buying, bought a whole bunch of stocks at the lowest points there a couple weeks ago when the market was so down and out, S&P 4,800 and change. And we're still sitting on cash. We still have a nice position in cash. And we're going to wait to see if this market heads back down to do this retest. And if it gets worse than that, if we slip into recession, I think I told you last week, even if we slip into a recession, I don't think the market goes a whole lot lower than where it was a few weeks ago. I think 4,600 is probably the lowest this market will get to if it really blows up. So we're sitting on this cash. And when we go back down, if and when we go back down, we're going to buy pretty aggressively. And if we don't, if we clear the hurdles, fine. We'll find opportunities. Look, there's opportunities in individual names all the time. I'm not worried about that at all. Look, we're doing great. We're back to positive on the year. I just love how everything's working out for us at the moment. We raised cash at really good times here. January 3rd, we took money out of the market. March 31st and April 1st, we raised up a ton of cash. And then we put some of that right back to work again just a couple weeks later in a downward move of this market. So I think we're in a great position. We're just going to kind of hold tight, let things play out, and what they say, play the cards as they come out of the deck, right? So that's what we will do. And that's what I've got for you. We got a lot more earnings coming out next week. We'll be watching those pretty closely. Some of these companies could give us a little bit more indication on the market. We've got things like Caterpillar and UPS. Going to be watching those things pretty closely, and we'll see what they've got to say. And we'll continue to watch these headlines on tariffs and see how the market reacts to all that. But between now and next we meet, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe let's take that big trip to Las Vegas and watch the Eagles at the Sphere. I've been told emphatically that is a show you don't want to miss if you are an Eagles fan, and maybe you don't want to miss it even if you're not. Hey, maybe you want to retire a little early, buy that second house. You know what your goals are. Don't just think about it. Think big. Think B.I.G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at B.I.G. Investment Services. For more information on B.I.G. and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.